thank you so much for taking the time to be here and to explain the Taxate program at Pennsauken Public Library, and also the changes to the changes to this year's tax preparation. I will hand it over to you two.
Okay. Okay. My name is Joe Casella. I'm the Camden County District Coordinator for AARP Tax Aide. I did want to say, even though this briefing is for Pennsauken, we are at a lot of different libraries in Camden County and also some municipal buildings. I believe there should be a list out there where we're located. The only big thing is that you must have an appointment. There are no more walk-ins. So with that, we'll go into the new and changed tax laws for 2021. We're going to cover retired accounts, earned income credit, education credits, charitable contribution credit, itemized deductions, the economic impact payments, the child tax credit, and the child care credit. Okay, AGI, you're going to probably hear this a lot if you're involved with the counselors. It's the adjusted gross income. It's your total gross income minus specific deductions, such as educator expenses, student loan interest deduction, unemployment, and it's usually line 11 on the 1040. Another term we're going to be using is RMD. It's required minimum distribution. This is usually from your traditional IRAs. It also can be from a 401k or a retirement plan. And MFJ, that just stands for married filing jointly. Okay, so the maximum age to contribute to traditional IRAs was repealed at the beginning of tax year 2020. It used to be when you turned 70 and a half, you had to start taking RMDs from your retirement plans. Most have taxable compensation during the year to contribute to an IRA. And that's because a lot of our 401ks and all, if you're familiar with it all, it is done with pre-tax money. So what happens is your gross is actually more than your taxable amount to the federal. So that's the difference. That's why when you start taking it out, you have to start paying taxes on it. Hopefully at that time, we're on a much lower tax bracket. So if you want to contribute to an IRA, okay, you must have taxable compensation during the tax year to contribute to the IRA. Taxable alimony is considered compensation. I think that's a new thing from a couple of years. Taxable non-tuition fellowships and stipends considered compensation. It must be included in your gross income. And that's usually paid to aid in an individual's pursuit of graduate or postdoctorate study. And you cannot offset required minimum distributions with an IRA contribution. What that means is you can't take an RMD that you're required to take and then move it into an IRA. For one thing, it's not considered earned income at that point. Okay. The RMD waived for 2020 only. What that meant was because of COVID, they had decided, IRS in their infinite wisdom, that you did not have to take an RMD in that year. And so it says if it was already taken, you could have recontributed it, but this is already passed, so it's too late to do that now. And it did not count as a rollover for your 1 in 12 months rule. That rule, what they're talking about is you can take an individual IRA and take the money out and then move it to something else rather than an institution to institution rollover. Okay, that's a difference. It used to be that you could do that as many times as you want. About 4 or 5 years ago, they changed it that you could only do one of them in 12 months. But like I said, if you have an institution to institution, like if you took it from Fidelity to Vanguard, that's okay. That's not counted as a rollover because it's from, you never actually see the money. It's all just paper. The age for beginning RMDs has been increased to 72 from 70 and a half. Only for individuals who reached that age, 70 and a half, after December 31st of 2019. So taxpayers born July 1st of 1949 through December 31st of 1949 will turn 72 in 2021, and they must take an RMD by April 1st of 2022. Now, what that means is that, so in 2021, you don't necessarily have to take an RMD, but in 2022, you'll have to take 2 of them, one by April 1st and then one by December 31st. So that's something to keep in mind. Otherwise, you just take it, well, it's too late now anyway, because we're past December 31st. So for taxpayers with no qualifying children, we're talking about earned income credit now. Minimum age used to be 25, now it's decreased to 19. The exception to the age 24 for specified students, definition of student, same as for advanced child credit.
American Opportunity Credit.
American Opportunity Credit, sorry, that's right, okay. So what they did is, I'm not sure really why they changed the age from 25 down to 19. It's like they're trying to compete, I guess, with New Jersey, because New Jersey last year had a lower age than the feds. I don't know why the two of them can't get together and have the same age, make it a lot easier for us tax preparers. So that means those born January 1st are treated as being born in the previous year. That seems a little weird, but that's the way it works. So what that means is if you had a New Year's Day baby this year, you can actually claim that child last year. The maximum age for the earned income credit was removed. It used to be 65, but remember, it's got to be earned income. So Social Security and Irs and all that stuff are not taken into consideration. Credit and income phase-out percentages increased to 15.3. They were 7.65. So all that means is they raised the adjusted gross income amount so that you might be able to still get some earned income credit. The phase-out amounts were also increased, and the maximum credit was almost tripled. So these were all things that they did because of the COVID. Here's something that they took away, which kind of surprises people. Tuition and fees deduction for higher education expenses were repealed. There used to be a way that you could either take the tuition and fees or take the educational credits, whichever was more beneficial. And what we used to do as counselors we used to do the return both ways and see what was best for the taxpayer. Now they've unfortunately taken that away, and they've actually gotten rid of that tuition and fees deduction. The $250 educator expense adjustment can now be claimed for costs associated with protective equipment, PPE. This is for teachers and stuff like that. But there's also a rule, I think you got to work 900 hours. Correct. So if you're only a substitute or a part-time teacher, you're not going to get that credit. And this had to be paid or incurred after 3/12 of 20. Okay, this is just repeating it's permanent now. Some of these changes they made as temporary, as you'll see as we go along. Some of them are permanent. This tuition and fees deduction permanently repealed after tax year 2020. But they say permanent, but they could always change it in another tax law. Lifetime learning credit has increased income limits. It's now the same as the American Opportunity Credit. They're the two kinds of educational credits you can get. Charitable contributions. Okay, for tax year 2020, the maximum $300 deduction per return for cash contributions to charity could be claimed even if not itemizing above the line deduction before AGI calculated. So what it means is most people nowadays, because of the double standard deduction they put in 2017, can't really itemize because it's too hard. Like a married couple, it's over $26,000. And there's just not that kind of itemized deductions anymore. But you can still take the $300. And what they added this year was it's $300 per individual. So if you're married filing joint, you can take $600. And that's usually, stuff that's either paid to your churches, Salvation Army, Red Cross, and stuff like that. It is a below the line deduction after AGI calculated. So what that does is whatever your tax bracket is, let's just say your tax bracket's 10%. So if you're married filing joint, that's going to mean $60 probably an extra refund or lower tax calculation. There's a new Schedule A worksheet from tax year 2020. It was updated in 2021. But like I said, most of us can't itemize. The medical expense threshold is now permanently at 7.5%. This was a big, I guess, political football. They kept on talking about making it 10% of the AGI. Now they've made it permanent at 7.5%. Still, with most of us, it doesn't help us because we don't itemize. Now, the good thing with the medical is, even though it's 7.5% for federal, it's only 2% for New Jersey. So even though you can't itemize on the federal, you may be able to take your medical expenses on your New Jersey. The private mortgage insurance, they treat it as interest now. It used to be a separate line called PMI, but now you can just put it in with your interest on your, usually what you get from your mortgage company. And here's the cash charitable contributions. Most cash contributions allowed up to 100% of AGI for tax year 2020 and 2021. That was only if you were able to itemize, though. And like I said, most of us can't itemize. Economic impact payments. It's also called recovery rebate credit. These are the two credits that came along because of the COVID. There was 2 rounds of economic impact payments sent out during 2020. They were advance payments of the recovery rebate credit that could be claimed on a tax year 2020 tax return. Hopefully that's done with. Okay, the problem we have is that the second one of that was sent late in 2019.
2020.
Now that should be okay. It's the one, this next one's coming up, it's going to be a problem.
Yeah.
The one that was sent in 2020, some people didn't actually get it till 2021, January. But it's not income, so that's not a problem. It's not going to be added to your income. So this was, you can claim and go back 1 second.
Sorry.
That's all right.
Did I go back? Did I go too far?
Yeah, just one screen. I missed that bottom line, I think, on it.
Previous. Sorry.
Okay. So you can claim an RRC credit on tax year 2020 tax return. And what happened last year was that if you didn't get the full amount, because they were basing it sometimes on 2018 or 2019 tax returns, then you were able to get it back in the 2020 return. Okay, that's what that was used for. It is a refundable credit, which is good news, because what a refundable credit means is even if you have no tax liability, you can still get a refund. A lot of the credits are not refundable. They're called non-refundable credits. And what they do is basically, they just reduce your tax liability. And once you get to 0, you're stuck. But with this particular refund, it was a refundable credit, so you would still get it. We would need to know how much EIP was received in both rounds. Now that was tax year 2020. Okay, y'all. So now they're talking about 2020 and 2021. So the EIP and the RRCs are not taxable income. Taxpayers are eligible to be claimed on another's return, not eligible for EIP or RRC. So what that means is if you had a parent that lived with you, okay, and they were claimed by somebody else, another sibling or something like that, then you wouldn't be getting credit for the EIP or the RRC. Taxpayers must have valid Social Security numbers. For first EIPs, if married, filing joint, both spouses had to have a valid Social Security number or no EIP was paid. It was later changed for RRC. Spouse with valid Social Security number could get the RRC. Child must have a valid Social Security number or ATIN. I believe an ATIN is something you can get before you actually get the Social Security. I think it's mostly for adoptions, because nowadays I believe children get Social Security numbers as they're leaving the hospital or before they leave the hospital.
The application is made anyhow.
What's that?
I said the application is made before they leave the hospital.
Right. Okay. So even though they have to have a valid SSN or an ATIN, they can't have an ITIN, which is completely different. Taxpayers must have a valid Social Security number for a child to be considered. If married, filing joint return, at least one parent must have a valid Social Security number for a child to be considered. EIP and RRC may be offset for past due child support. So what that means is you might have some people complain that they didn't get their EIP and their RRC. And if you talk to them a little further, it might be that they owe child support. Well, that's one of the things that the federal government will take away from any of your refunds. They will send it on to the state for child support. It does not apply to other federal offsets, though. So that means if you owed money to IRS, they wouldn't offset it to that, which is silly, but they should do that. But that's beside the point. Okay, this was another tax year 2020, I'm sorry, not 2020. First round of EIP1 sent to eligible taxpayers starting in April 2020. It was $1,200 for single person, $2,400 for married filing joint, and for each dependent under age 17, it was $500. The second round of the EIP, which is where the problem is going to come in, I'm sure, was sent to eligible taxpayers at the end of December 2020 or the beginning of January 2021. That one was $600 for single people, $1,200 for married filing joint, and $600 for each dependent. That's the one we're going to have to be careful with, because remember that even though they got it in 2021, it was actually for 2020. Both EIP1 and EIP2 were reported on tax year 2020, return and reconcile with the RRC. EIP3 is an advance payment of the RRC. It's based on your tax year 2020 return. It could be based on your tax year 2019 return if the 2020 return was not filed. And if you didn't file either year, it was based on available data, whatever that would be. I don't know. I guess it could be Social Security or something like that. True up of EIP3 payment on tax year 2021 return as RRC. IRS will send a letter, 6475, in January of this year, so that should be this month, noting the EIP3 paid and any plus up payments made after the processed taxpayers 2020 return.
And they're really slow on getting those returns. I just saw numbers, it's like 6 million returns have not been processed yet.
Really? Wow.
6 million.
That's not good. Well, they're still not in, I still think they're working from home, most of them. So if it doesn't go through electronically, it becomes a real problem. Okay. Okay, so the child tax credit. This credit was increased from $3,000 to $3,600 if the child was under 6. Previously, it was only $2,000. Now, for this year only, the qualifying child age 17 is eligible. In previous years, you had to be under 17. But for this year only, they're saying the child can be 17. It's fully refundable for tax year 2021 if your principal place of abode is in the United States or a resident of Puerto Rico for more than half of 2021. Either spouse, if married, filing joint. And as it says on the bottom there, it only applies to tax year 2021 returns. Now, with this child tax credit, what happened was, I think it was started in July.
Correct.
People that had children were getting $300 for each child automatically sent to them, whether it was by check or directly into their accounts. So half the year they got this child tax credit, and IRS is sending out a letter, 6419, that's going to show the amount that they got. Clients that have children are going to have that letter before we can do their tax returns. And it becomes very weird because IRS issued the 6419 to each spouse. And what they did was they divided the money in half. So let's say you had, even if you only had one child, and they gave $300 a month for the 6 months, that would be $1,800. Each spouse would get a letter 6419 showing one child and $900 of advanced child tax credit. And we need both of them because we have to add them together. And if we don't report the right thing, I can almost guarantee you that the return is going to end up in limbo, and who knows when it'll be actually resolved.
I received mine and my husband's today, actually, our 6419s.
Okay, and what did it show? It showed one child, or?
We have 2 children, but you're right, it's split in half. But okay. They just arrived in the mail today. So
Okay, yeah, they're a little late, but they're supposed to be out by the end of, well, it's January 27th, so that's not too bad.
yeah.
Okay, the child care credit. This is something that's really good that they did. The maximum expenses eligible increased to $8,000. It was $3,000. That's for one child, and $16,000 for two or more qualifying children. That was $6,000. As you can see, that's a tremendous increase. And that you usually get about 20% of that back. So that's pretty good. The maximum credit is now 50% of expenses. It was 35%, so maybe even going to get more, who knows? Maybe more than 20%. The income phase down of percentage begins at adjusted gross income of $125,000. It was $15,000. So more people will qualify for this maximum 50% amount. And this is also, remember, this is also tax year 2021 only. So it's going to be kind of crazy next year, I guess, unless they re-up it. It's now a refundable credit. Remember what I said, a refundable credit means you can get money back even if you don't owe any taxes. Last year, it was a non-refundable credit. So, and it's for taxpayers who have a principal place of abode in the United States for more than half the year. Taxpayer or spouse, if married, filing joint, and it remains non-refundable if your abode is outside the United States. So if you live outside the United States and you don't have any tax liability, you're not going to get any money for this. Okay, so now we're going to talk about the new service delivery models that we have. And the one that's going to be at the Pennsauken Library is going to be what we call the drop-off method.
Oops.
Oh, was it? We were shooting with the protocols? Okay.
Oh, I'm sorry.
That's okay.
Want me to go? I can come back.
Yeah, that would probably.
Okay.
Okay. So this is the same day drop-off model. We have appointments only, no walk-ins. Appointments can be made online, and I assume that's the tiny URL we call it for Pennsauken, right? Appointments can be made on a Pennsauken Library computer. Pennsauken has been one of the libraries that's been very nice to us, and they've actually set up the tiny URL on one of their computers. And actually, I believe some of the librarians are even very experienced in it.
Oh, yes.
Okay. You have to complete all forms in advance of appointment. You bring a copy of your 2020 tax return and all 21 tax documents and IRS letters. And that's those two letters we were talking about, the advanced tax credit and the child care credit. If missing a document, for example, a W-2 or a pension statement or something like that, cancel the appointment and reschedule. I know it's tough because we don't have as many appointments as we used to have when we used to have walk-ins, but it's just, I guess it's the new way of doing business, unfortunately. What will happen is you will get a short interview with the Irs Certified Tax Counselor. We're talking about maybe 20 minutes at the most. What they will do is they will go over the intake sheet with you, go over all your tax documents, and have you sign a couple documents. One is the IRS form saying that you agree to us doing your tax return this way. And the other is signing off that you've given us your tax documents, and then you leave. You go home or whatever, but you must be available for a phone call in order to have your return quality reviewed or if there are any questions on it. This is what we talked about, signing an inventory sheet listing all the documents that you gave us. And we, at that time, we will schedule a return for you, a return time for you later in the day to pick up all your documents and your tax return. Must be available by phone. For some people, that may mean that I know some people have a block on there. If you have a block number, that could be a problem. I think the only thing we know for sure is that it will be coming out of a Boston area code, 614. Is that right, Ellen?
I don't remember.
It's either 614 or 617. I forget.
617. That sounds better.
617. Okay, so that's what it'll be coming with. You're going to meet with the quality reviewer on return to visit to review your tax return and confirm that all tax documentation has been returned. If married filing joint, both parties must be present because you must sign the 8879, which is the form that allows us to e-file your return. Also, there's information about there. If you don't come back the same day, you're signing also a document that says that if we can't get a hold of you within a certain amount of time, we will wind up destroying all documents. So it's very important that you come back the same day and that you're available for phone calls so that we can finish everything up in one day. Okay, so these are the type of things that are out of scope. We don't do gig workers like Uber and Lyft and DoorDash, etc. We do not do any Bitcoin. I know some people are into that, but it's just not, it's one of the things that's completely out of scope. If you have complex or very lengthy stock brokerage statements, I remember one time we had a guy come in who did daily trading. He had like 30 pages of sales. We just don't have the time to do that. We didn't even have time to do it back then. We sent them away, but definitely not now. We will set up a separate appointment if needed for amended or prior year returns. And normally only one tax return will be prepared per appointment. Okay, I guess this is where you come on.
Yeah. You got it. Okay, for those people who would not like to come in to the tax site, there is a virtual model that's available, which some people used last year. It is a statewide program rather than a local program. And there are some requirements, though, of the taxpayer. Somebody who would like to participate in this needs to have reliable internet connection, a computing device, preferably with a camera and microphone. It's possible to do this without, but it works a lot better if the tax aid counselor can see what it is you're doing. The people who participate in this program generally are technically savvy, or they have a family member or a friend who is available to assist. And similar to the drop-off method, we are not doing shouldn't say, if you do not have a complex return, we can help. If it is too complex, we cannot. Okay, how do you find out about this offering? Well, it's available by going online to the AARP Taxate page, which you see on your screen, to request assistance with preparing your own tax return. There's a, click here, click there, but you want to do is request help and complete the form that sends the request to the ATP state lead, who for New Jersey is me. The first contact, though, that you will get with a human being will be what's referred to as a screener. And that screener asks questions, just like the counselors would ask at the site, such as, married filing jointly, do you rent, do you own, those kinds of questions to get an idea of what your needs are in terms of the tax world. But we also need to know about your computing device, or how technically savvy that you are. The biggest issue is that the compatibility with the tax software that is used, we cannot have somebody who is still using Internet Explorer, for instance. That will not work. The next contact, again with a human being, is with a IRS and AARP Certified Tax Counselor. The people who are certified to work at the sites are the same people who are working as assisters virtually. The ATP Assister is available to answer questions for somebody who's started working on the free tax software that is available and they got stuck. Or they can assist the taxpayer through the entire tax preparation process or anywhere in between. Sometimes people just need to get started, and once they get a hang of what's going on, they can take it from there. But the assister can guide the taxpayer through the entire tax prep process as a video meeting. And the video that AARP uses is Google Meet, which is very much like Zoom, but this is a more secure, process using the Google Meet. So for Google Meet, there is a option to present now so that you, as the taxpayer, will be showing your screen to the assisters so that they can see what you're doing and can tell you where to put specific information, or if you have a question, what do I put in, this box, they can see which box you're talking about. But the whole point of this is that the taxpayer is preparing their own return, and they're using the same software that is used by the Taxate site counselors. So they're very familiar with that tax software. At the completion of the tax prep process, so this means you're on the phone, on your computer for the entire process, the taxpayer then files their own return electronically and sends it off to the IRS in the state of New Jersey. However, the assister is available for follow-up for any calls, emails, texts, whatever the questions you may have, except for where's my refund? We cannot answer that question. But they are available for follow-up. One of the things we learned last year is that the taxpayer who does their own return online, they need to either print it out or save it as a PDF, because at about October 15th or thereabouts, all the information that had been on our system on the Chromebooks gets wiped out. So there is no way to retrieve any information that may have been learned with the process of preparing tax returns. So after that point in time, the only way to get a copy of your tax return is by going to the IRS and requesting a transcript. But
well, let me step in for a second.
Surely.
We are not keeping any client information on our Chromebooks if they're doing the ATP, correct?
That is correct. All the information that's being saved is with the software vendor. And when they change from one season to the next season, that anything is wiped out.
Okay, but I just want to say that there's nothing on our Chromebook.
No, there's nothing on our Chromebooks, no.
Okay.
No, that was the whole point. But the reason for the Chromebook was because of the Google Meet and having the security that was in place. But no, the issue is not so much our Chromebooks, but the access to the vendor's software. Yep. Okay. For our ATP, our out of scope is somewhat similar to the sites, except that because we cannot see the documents, we can't handle the documents, there are some things that ATP will not do. So for the sick and family leave credit for self-employed, we will not be doing that. It's a lot of bookkeeping, record keeping that is required. And so we will not be handling those kind of returns. Similar to the sites, the gig workers, the Uber, Lyft folks, they are, again, too complex for the process that's being offered. Similarly, the stockbroker statements. Also, with ATP, will not be doing any amended returns nor prior year returns. The reason being is that the software is available for that, but it is not free. There is a cost. And so as a free service, we will not be in a position, nor can we, according to the IRS charge. We're not charging, it's the vendors that are charging. But the point of it is that the service that's being offered is a free service with free software.